Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks, episode number 91. And in this episode, I'd like to go into evaluating market macroeconomics as well as looking at bulls versus bears. And before we get into that, it's June 29th, 2016. I had some critical charts that I posted. As for today, let's just take a look at the market and see how things are moving. So if you look at the market overall and we go into the weekly standpoint, you can see that we've made all-time highs at this price level. Okay, so the SPY all-time highs here is right around the 2113 level, give or take. If you look at the SPX, you're looking at right around the 2140 level. Really, it's the all-time highs here is 2132, and then if we go into this bar right here, 2134, so call it 2135. Now, if we look more into the immediate action of what's going on with all this Brexit ordeal, I'm probably sick and tired of hearing all this stuff because the market's doing some weird things and some things I haven't really seen before in the past, at least not directly. So there's a lot of interesting things that are happening. And when you start looking things at a bigger picture, you start to question and wonder really what is the market doing? And this is where some doubt sometimes starts to creep in. So looking at the market, we had this Brexit happen over here. At first, everybody was positioning to the upside, meaning they were expecting that they would remain. So they were positioning it this way. For me, most of you know I was going short, and then before that, I was balancing out my position to have a little more balance depending on which way the vote would go. Anyways, what happens in these scenarios is when you have a combination of shorts and longs, you're able to take your positions off the table and take your profits and allow the others to catch up. And then you get out of those shorts, you take some profits and you flip and go into the long side. Now, normally you don't see a full whip action like this, snap down and snap back so quickly, and it makes me really question the move that's happening. And here's why I kind of question it. When I look at a longer term picture, and if we get rid of all these drawings right here, if I look at the overall, let's just take a look at the monthly chart, and I look at market extensions, how far they've gone, how far they're going, the pace of the market, you can really see this moving average line. Okay, so to me, if I'm just looking at this moving average, let's just make it a little bit brighter here. And you can really see that moving average line. So the market, as it works, is more like a rubber band. So as we get too far extended, let's just take a look here at the year 2000. We pull back to about the moving average because the moving average here is right around at the 1,000 level. So we got into 1,500 and we pull back to about 1,200. And then we sell off and go beyond it. We go way further beyond the moving average, and then we whip back. So that's why we technically had a sideways action here from 2000 to 2009. Then again, it overshot it on the upside in 2008. Okay, and then 2009, we overshot it to the downside, the sell orders, because of fear and panic. And this is what markets do. And really now, then we popped, and we continued. Really, when you look at from 2000 to 2011, it's kind of a sideways market when you think about it. If you look at the moving average, it's really just a sideways market. And now what's going on and what's happening is we powered through that. And let me just draw the highs at the year 2000, at 2008, which is right around 1500 level. You can see we got a little bit further away from that moving average. Again, we're at 2124. We're near those highs, and now again we're further away. And when you get this far away from something, it makes you wonder what is behind the move. And as I look at the bigger picture and as I look at the macro sense, macro meaning the big economic standpoint, you have the Fed that prints more money. You have the European Union here with the Brexit vote happening. You have interest rates that are negative in certain parts of the world. Our interest rates are low. Job growth is low. Company profits some are profitable, but the way that they're getting their profits is not through more sales technically. It's not through really company growth. It's more through, you could say, job cutting. It's more through expense cutting. Or the other thing that they do is they pre-sell earlier in batches. And what they'll do is they'll go ahead, like for example, certain companies, they'll go ahead and sell to another company earlier, and then they'll deliver it a little bit later, or they'll sell it earlier, ship out those goods, but that means it's going to reduce your sales in the future, in the second half of the year, which right now we're coming into that kind of second half of the year. It's, we're halfway there between the 12 months. So as we look now into the market is at these super high prices, and I start to question, okay, what is going to drive this market higher? What is behind this move? What is really going to make it sustainable? The next thing I also look at is I'm looking at this wave pattern of volume. Okay, we had massive volume coming in from 1995 coming in, and then we have this bell curve effect. We have a slope down. Okay, and then again, a pickup in volume. But I'm also looking at the bigger volume spikes. So as we go more closer, what are the bigger spikes? And you can see we're looking at the monthly chart. And it doesn't take a rocket scientist to see the bigger volume spikes are actually the bearish side. Okay, so the volume is really on the bearish side here. Now, can the market keep going higher? Can we continue to inflate prices? Absolutely. Absolutely, it can keep going on air. And the way that it does that is, well, the Fed comes out, says, well, we're not going to raise interest rates. What we'll do is we'll go ahead and pump more money. We're watching. Things are cautious. Don't worry. We're not going to act too quick. And they'll support these things. And then the mom and pop, the retailers, the person who's new to stock trading, they go ahead and they put their money into the market. And then eventually, within a couple months, within a couple years, things eventually unfold and say, well, those things aren't working out. And then you get those crashes, or you get a massive pullback, which is what happens really in these timeframes in 2000 and 2009. Got a little bit of that in 2011. That also happened. But in general, when you look at bulls versus bears, you're constantly fighting this battle, and you're looking at where are prices a little overinflated, hyperinflated, where are they too far to one side or the other. And when I look at it this way, I don't see what's driving this market higher. That doesn't mean the market can't go higher. Can we go to, the way I look at it is I start bringing things in from the outside edge. So I look at it, is it possible or realistic? What are the chance? If you've studied statistics, or you just know about probabilities or the chance, just basic chance statistics, you can kind of do some rough estimations. So what is the chance of the stock market going back down to, let's just say 100 on the S&P? Probably very slim. Okay, what about if I say 11,000 on the S&P? What is the chance of that? Again, probably very slim. So what I do then is I slowly start tightening these things up. So I'll go to, well, what about 6,000? 6,000 is nearly 3 times what it's currently at. What is it likely for the market to get to those levels? In the shorter term, probably not. Okay, so then you can also move this up. So you continue doing this. So what about 700? What about 800? And then what about, 4,000? Is it likely that the market is going to get to 4,000 in the next year? Probably not. How about 3,000? Okay, so you slowly start tightening this curve, and then you start getting more of a realistic picture. What about, 2,500? Is it really likely that you'll get the market over here? Because if you get it all the way up here, this moving average will be kind of over in this level, so it'll continue to stretch that moving average. So you're looking at probabilities of what is it that's going to happen. and you slowly start tightening things up. Now, the reason that I say that the market can still continue to move higher is simply because of you keep getting this influx of support from the Fed, support from other areas. So where do you go with your money? Now, is it doing it on volume is the question. And when you look at the volume, I don't see the huge buying influx of volume. And when people are sitting on the sidelines and they think the market is overpriced, they're just waiting. They're waiting, but then you get little people nibbling, then it continues to push it higher. You get a few more people nibbling, it continues to push it higher. And then eventually that's where you get the rug ripped out from under you, is when you keep, pushing it, and then the regular retail investor is the one that's buying it there at the 3,000 or 4,000 level, rather than on pullbacks. Or you have people that missed out on the opportunity. So when you miss out on an opportunity, let's say you get something like this Brexit thing coming in, then you get more money stepping in. Now, oftentimes when you look at a bullish versus bearish scenario, You'll notice that you'll get more bullish days than you get bearish days. And that is just simply because it takes more energy for the stock to move higher. Okay, it takes more energy for a stock to move higher. And people, markets, as I always like to say, markets do not crash up. They will crash down, but they don't crash up. Sometimes it feels like they crash up, but most of the time they don't crash up. They'll move higher, like we did the last few days, but then they come back to more normalized levels. But when you have a crash, you really take out and whip out a lot of gains within a few months. So when you look at this pullback here on a down day on this Brexit vote, we had a 90 point or so drop, and it took out about 3 to 4 months worth of gains. Okay, now it took 3 days to make up for those 2 days. Okay, and if you look at any big red bar and compare it to previous bullish bars, you'll often find that you'll get wider red bars, but you get more green bars. So typically on a day-to-day basis, it pays off to be a bull, but it's all comes down to managing your risk, managing your positions, because you get a wider price spread on bearish days. So take, for example, let's just take a look here. If we go into these 3 days on the S&P on 2015, right around August 19th, August 20th, August 21st. So here we sold off on the S&P about 230 points to the downside. Now, we got a few days of pop here, and then again, we sold off, pop, sold off. But from those 3 days of sell-offs, to make that up, how long did it take? It took 2.3 months to make that up. 3 days, it took 2.3 months to make that up. How much of those gains did we really wipe out? So here were our 3 days. Okay, the gains were all the way from, 2014, October 17th, 2014. So it took, 10, 11 months of gains wiped out in 3 days. 11 months of gains wiped out in 3 days. So when you're watching this, you have to remember that, number one, if you're comparing bulls versus bears, typically most days are green. I mean, if you look at this picture, most of the time they're green days. But the red days, when they come, this is really where you're always protecting yourself. Because when the red days come, they wipe out your 3 to 6 months worth of gains in 1 or 2 days. So that's why it's important for you to really be cautious about the market, more so on the downside than for the upside. So for me, it's one of the reasons why I typically like going short when things are overinflated, when things are a little bit overpriced, is because when you have high prices, eventually you'll get a major market move. However, if you're long and you get a really dangerous move to the downside, it can really wipe you out for almost a whole year right there, because you have, 6-8 months of gains that gets wiped out, and maybe sometimes even goes beyond that. So for me, I'd rather take the pain on a day-to-day basis rather than look to be always profitable on a day-to-day basis. I know it's a little bit different. It's a little counterintuitive. So looking at the current market as it is, as I look at bulls versus bears, I'm always comparing the energy. How is the energy look? Remember, we still have that big macroeconomic in our mind, in the back of our mind, but now I look at the energy. So I look at the energy is based on the volume. So this takeout day was 333.3, very interesting number, 333 million to the downside. Then we had 248.9 million to the downside. We got back up into that level at 159, and then we got back up again at 137, and now we're at 104. So let's just say we'll wrap up the market. We still have about another 45 minutes to an hour here to go. We might get back up to, let's just say 140, but it's nowhere near 333 million. Now I understand some people had to cover their shorts and things like that. So we're coming in, we're filling this gap. That's what it's really attempting to do. We may even get to all-time highs, but to me, I look at it and say, what is different this time? That they're going to print more money, that their UK is in a better position. What is taking the market higher? What is underneath it? So you always want the bigger picture. What is your reward to the upside versus what is the reward or the potential, kind of like what we did with the statistics, moving the lines there. What is the probability of it continuing to power higher versus lower? What's the likeliness of that? So you want to always look at that. The other thing I always like to look at on these moves is when you get these moves here like this, you have to remember we're coming into, number one, the end of the month, the end of the first half of the year, and with that in mind, we're coming into a Friday and a long holiday weekend. So when you have all those things working together, you get the jobs number out tomorrow, you want to see what happens to this market. And that's kind of a dangerous place because you get window dressing that starts to happen right now. There's pension funds that have to input money into this market because they are, they have money sitting there, and those people that are trading and managing their money, they have to show them what's on the report. And this is what window dressing is all about. They'll buy those positions so that way they can send a statement out showing them that, hey, you have Apple position or a Facebook position or this position or ExxonMobil. And that's what window dressing really is all about. It's about showing the regular retail person that gets a letter in the mail every month with their investments. It's about showing them what they have. And it doesn't show them exactly what date they got in it. So what they'll do is they'll go ahead and post some of these things right in there towards the end of the month or the end of the quarter or end of the year. And they'll do some buying just to show them on that printout because they have to show them something. And that's what happens with the window dressing. So to me, going into this July 4th weekend, it becomes a little more cautious in the sense that now I start looking at, okay, what are the individual bigger names doing, like the Facebook? And when I look at Facebook on a day like today, on a major up day here, we have the S&P. You can see we're up about 21 points or so on the S&P. So on a major update, why is Facebook not reacting to the upside? I question that. Then I look at what's another powerful company, Amazon. Okay, why is Amazon, when we look at the weekly, came into this support level, we bounce here, but on a day like today, we're only up 8 cents. Makes me, again, question the move. I take a look at Netflix, another popular company. Again, on a day like today, I understand Netflix has had some problems with earnings and so forth, but on a major day like today, why is this stock only up 11 cents? Look at maybe another favorable company, Tesla, only up 68 cents. For a stock that moves $10 in a move without a problem, $3, why on a day like today is it kind of moving like this? Then another one you might want to look at is, let's just say, Apple. So again, this one's got a little bit of a bounce, but where is the volume? That's another thing I'm watching. So I look at these bigger boys, bigger players, what's going on with them and how are they trading? How are they acting in these kinds of markets, in these kinds of environments? And then you start to wonder, okay, why are those big players not moving as much when you compare it to the overall market? Even a stock like Home Depot, which has been doing really well when you look at it on a monthly basis, it's been moving well. You can see the bearish volume starting to pick up right now. The month to month, we are having bearish volume that's starting to come in. Okay, these things don't develop overnight, but you can see that this month it's starting to pick up. The train is starting to go in the other direction. Now, would I short the stock? No, I wouldn't. But you can see that the bearish volume is picking up. They're selling, which means there's distribution. The big boys are starting to get out, and the retail traders are thinking, oh, it's a good time to buy. So, it could the stock go higher? Yeah, it may if it gets a little more sideways action. But you start to wonder, okay, what is driving the market? What is driving it higher? What's going to continue to drive it higher? So again, on a day like today, why is this stock only up 8 cents? On a Dow market of about 190 points, almost 200 points. Why is a Home Depot only up, that much? Why is a Facebook only up 1 cent? In fact, almost going negative right here. Why are they doing that? So think about that for a moment. As you come into a holiday, as you come into Fridays, as you come into end of the month, when you have all these things working together, end of the month, you have Friday, you have end of the half, okay, 6 months of trading. You also have pension rebalancing and all those things working together. What is going on? And sometimes you have to step aside and let things digest, give it 1 or 2 days even after the holiday. And then you also have this shortened holiday week with July 4th for the U.S. markets. So again, some things to think about and things to consider. And if you're unsure of the direction, then step aside and wait until things digest. Because when prices are a little too inflated, what happens is we trade a lot on emotionals. So here on this down move, people get scared and they trade emotionally to the downside. Then again, you get the whipsaw action to the upside, and then it overshoots it to the upside, and we get emotional buying saying, oh, it's going to the moon. Look at that rocket ship to the moon. And then again, you get a pullback when really the more normalized level is probably, somewhere around 2062 or so, or maybe 2070 rather than all the way up here. So you overshoot it in both directions. If you look at more on the weekly, we're kind of overshooting it as far as the moving average is concerned. We're overshooting it already by about 60, 70 points. So right here would be more of a normalized level. So again, the market overshoots it one way or the other. And when you look at these candles, you see the majority of them most of the time will be green bars. However, the red bars will typically be much larger. So the red bars will wipe out more of the gains on a shorter time frame basis. So those are some other things to consider. And then again, of course, the macroeconomic news as well. What is driving the market? They can continue to print money. They can continue to say we're not going to raise rates. But what else can they do? They can do the stimulus package like during the Bush era where they send you 200 or 400 or however much dollars they sent you to go ahead and spend it and use it for the economy. For me, I just saved it or put it in the investing account. But do those things work? They try things, but really ultimately, eventually, you have to have a pullback. You have to have a little bit of pain to be able to go higher. For a trader, for an investor, you want things to always move in the markets and come back to more realistic levels. Because when a stock pulls back, maybe it's a little un-American, but when stocks pull back to, let's say, 1500 S&P level, that's going to create phenomenal charts, great opportunities. Yes, it's going to wipe out a lot of people's 401ks. It's going to hurt a lot of other people. But that's going to create more opportunities for the trader, for the active investor. It's going to create a healthier market in the sense where we're not printing money, where now you actually have to have money to buy something rather than purchasing things on credit or just simply printing out a sheet of paper to be able to get a mortgage on your house. You need to have a higher down payment, just like they used to do. But now it's, for the money sense, there's just a lot of that credit that keeps getting pumped into the economy, and all that just continues to drive these things. And it's important for you to look at it from a wider perspective. And as you look at the market in this way, start looking at it more in a realistic sense. What's real? Is it real for the market to be maybe at 200? Probably not. What about 5,000? Again, probably not. So you start tightening these levels and start contracting it. What about 3,000? Again, I'd say it's probably overinflated at 3,000. Could it get to maybe 2,300? Yeah, that's possible. But is it, probable to happen in the next month? Probably not. How about in the next 2 years? Maybe, that's a little more possible. So start tightening those things up and looking at it a little bit more of a bigger picture. And you have to look and realize that these companies, these earnings, the way that they're happening, a lot of it is just due to job cuts. A lot of it is due to, pre-selling earlier orders, which is going to hurt their earnings sometimes in the second half. And they do that because they know they'll probably sell more later in the second half anyway, with Black Friday, with Christmases, all those kinds of things. Summertime, people take vacation. So all those things are things to consider and think about as you trade more in a environment like this. And as we come into the second half, those are all things to consider between Friday, end of the month, shortened holiday, or shortened trading week with the holiday longer weekend, pension rebalancing, again, earnings, you got the Brexit, the Fed printing money. Think about it. What's driving profits? And, stocks may go higher, they may go lower. No one really knows, but it comes down to what is the risk, what is the reward? What side of the trade do you want to be? Do you want to be more, let's say, 2-to-1 positioned long, or do you want to be more 1-to-1, a little balanced, have a few shorts, have a few long positions? Really just comes down to your risk tolerance and the environment that you're in. So always be mindful of these things as we approach levels like this with the end of the month, the end of the quarters, the holiday breaks, all these things, because they'll whip around and overextend in both directions, to the downside and to the upside. But the normalized level, where should it be? That's really what you're always looking for. Thanks for joining me this week. I really hope you enjoy the lessons here. We're hitting episode 90. Really, we're beyond episode 90. There's been times where I didn't even number these things. So if you haven't had a chance, make sure to visit me on the website, because there's also some hidden episodes that aren't released on YouTube. I really enjoyed this last week. We were actually in Chicago, and it's not something that I always post in advance just due to safety, security reasons and things like that. But in Chicago, there's really nice, really lovely. I've been to New York, lots of lovely things in New York, but Chicago really surprised me. I really thought for a city that large, there would be a lot more debris and a lot more trash, but it was really clean, really amazing, great hotel. Lots of lovely places that we stayed, ate, and had a lot of great food there. If you ever go to Chicago, or you've ever been to Chicago, or you live in Chicago, definitely recommend the Purple Pig there as far as the restaurants goes. Had a lot of amazing food over there, very social with some people, and just a nice little time to get away here during these little whipsaw markets. So we were just there really for the weekend, just to take some time off. And now I'm back recording more videos, working on some more training material. I'll be working on another book here that'll probably be released towards the end of the year. A free book as well. We'll do a free promotion on it. It's more about psychology of wealth building, which will help you out with trading as well. So I'd really highly encourage you to look at that. It all comes down to about how the brain works as far as making purchasing decisions, buying decisions as far as profits, losses, and those kinds of things, but also it will apply to your regular day-to-day life as well. So again, thanks for joining me. Enjoy your weekend here. Long, happy 4th of July weekend. Be sure to check out the website there. You can sign up to get a free critical charts on the services, and you can also subscribe on YouTube. Thanks again, and remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.